Welcome to the deep dive. Okay, we have a massive stack of sources today, and it really captures, I think, the chaos and just the sheer speed of modern business right now. We're deep diving into a world where, get this, you can get everyday stuff delivered to your door in maybe 6 minutes, while at the same time you've got these huge debates raging over, like, AI governance and the future of global commodity markets. It's a lot. It is a lot. It's a dizzying mix, yeah. And what's fascinating, is how this extreme disruption is hitting everything at once. Physical infrastructure, high finance, geopolitical policy, it's all connected.
Right. So our mission today really is to quickly unpack three major themes we pulled from all this material. First, this new, almost unbelievable pace of the physical economy and the kind of surprising infrastructure that's making it happen. Second, we've got some high-stakes corporate drama, big valuation battles defining market moves right now.
Always entertaining, that.
And finally, the really complex geopolitical tension that's absolutely, influencing global markets. You can't ignore it. Okay, so let's unpack this. We need to kind of follow the thread, right? See how you get from 6-minute delivery times all the way to billion-dollar activist campaigns and global trade spats.
Exactly. Let's start with that first theme, the new pace of the physical economy. I mean, it really wasn't that long ago that 2-day shipping felt like a luxury.
Oh, yeah. Prime 2-day shipping changed the game.
And now Amazon is just compressing that down to a window shorter than, like, making a cup of coffee.
Yeah, that's Amazon now. So they started this strategically in parts of India, Bangalore, New Delhi, and now they've rolled it out in the United Arab Emirates. The promise is, everyday essentials delivered in 15 minutes or less.
15 minutes is already pretty wild.
Yeah.
But the number that jumped out at me from the sources, some neighborhoods are seeing deliveries in as little as 6 minutes. 6
minutes. It's almost hard to process. That isn't just speed. It means Amazon is completely rethinking the physical footprint of retail. This kind of velocity, it only works because they've built this sprawling logistics network, these neighborhood micro-fulfillment centers. They're tiny, hyperlocal warehouses, basically, stocked just for that area, running 24/7.
It's like turning cities into distributed warehouses.
Pretty much. And for Prime members, you get this speed practically free if your order is over, $6 or so?
Yeah, about $6, 80, 25. Small orders have like a dollar fee.
It just shows how logistics and infrastructure are now the ultimate competitive weapons. It's all about who can move stuff fastest.
Right. And this theme of velocity, it seems to apply even to things we think of as really slow, like physical assets. Let's talk commercial real estate.
Yeah.
The sources say blockchain is starting to speed things up here, though admittedly it's happening slowly.
Yeah, the description used was a great big virtual filing cabinet, which is a good way to think about it. Secure record keeping for deeds, titles, mortgage bonds, all that stuff.
Okay, but here's where it gets really interesting, I thought. Tokenization.
Ah, yes. Tokenization.
This idea of converting CRE ownership rights into digital tokens. So you can own, like, a tiny fraction of a building.
Yeah.
And trade it easily.
Exactly. Fractional ownership, easier trading of shares in a property. And the scale we're talking about, well, Deloitte's forecasting something huge. They think 4 trillion with a T of real estate will be tokenized by 2035. That's up from less than $300 billion this year.
Wow. $4 trillion. That's massive.
It is. But there's a key regulatory catch, at least for now. U.S. citizens currently can't invest in tokenized U.S. real estate because of regulations. International investors, fewer barriers there.
Okay, so that's one angle. But there's also a more immediate financial application, right, around mortgages.
Yes, specifically transferring mortgages. Platforms like BV Innovation are using AI and blockchain to create these transferable mortgage bonds. And this tackles a huge pain point in CRE. Those massive prepayment penalties.
Oh, yeah, those can be killers.
They really can. Imagine you own a commercial property. You've got a great low interest rate from a few years back, say 4.5% on a $20 million loan. Now, you want to sell or refinance, but the penalty for breaking that mortgage early could be millions, like $4 million in that example.
House.
Right. So this blockchain platform lets you potentially transfer that existing mortgage with its low rate to a new property you're buying, circumventing the penalty. It's kind of like taking your low-interest car loan and just slapping it onto the new car you bought, even though the bank normally wouldn't let you do that without paying up big time.
That's a really powerful application.
Yeah.
Okay, speaking of massive physical investments, moving maybe a little slower, Jamie Dimon, JPMorgan Chase, their new headquarters.
Ah, yes, the new $3 billion tower in Manhattan. 60 stories. And it was designed explicitly as a recruitment tool.
A $3 billion recruitment tool. That's quite a statement.
It really is. It's designed to be a destination, something that makes the commute worthwhile, you know? It fits 10,000 workers, biometric access, an employee app for booking services, even a drone port for package deliveries.
And the amenities. I mean, it's almost over the top. A Michelin-starred vegan restaurant.
And a cafe serving protein shakes out of an Airstream trailer. Don't forget the English-style pub.
Right, an English pub.
But like Diamond's trying to build a corporate theme park. The whole goal is this elevated experience to lure in and keep top talent, especially since he's such a big advocate for office work.
It's such a contrast, though. That $3 billion bet on physical presence and stability versus the sheer volatility we saw elsewhere this week. Which brings us to our second theme, high-volume corporate swings and drama. First up, Beyond Meat, the meme stock is back.
Oh, it's back. Beyond Meat shares surged over 146% on their best day ever, which is pretty incredible for a stock that just the week before had tumbled, 67%? And it's been trading basically as a penny stock for a while after peaking way up over $230 back in 2019 after the IPO.
So what was the spark?
Two things, really. One was some actual fundamental news, a new distribution deal with Walmart that's potentially good for business. But the real fuel for the fire, its inclusion in the Roundhill Meme Stock ETF.
Ah, one of those ETFs that just tracks highly volatile retail investor favorites.
Exactly. Getting added to that ETF basically put a huge target on it. It triggered a massive short squeeze. Apparently, over 63% of the available shares were sold short last week. People were betting heavily against it.
Wow, 63%. That's huge.
It is. So when the price started ticking up, all those short sellers had to rush to buy shares to cover their positions, which just sent the price rocketing upwards. Totally disconnected from immediate fundamentals, mostly just momentum.
Pure market mechanics. Okay, we also saw some unusual players getting into corporate activism, mixing finance and celebrity.
Yeah, this was interesting. NFL star Travis Kelce is teaming up with JANA Partners. JANA Partners, they're a pretty well-known activist investor group. They target companies they think need a shakeup.
And they're targeting Six Flags?
Six Flags Entertainment, yeah. The investment group has about a 9% economic interest. And Kelce says it's personal for him. He grew up going to the parks. Six Flags shares jumped over 15% just on the news. So clearly, celebrity involvement and maybe a bit of nostalgia can still move the needle, even for a stock that was down almost 50% year-to-date before this.
Fascinating. And speaking of big market movers and corporate drama, we have to mention Tesla, right? That ongoing $1 trillion question.
Right. That phrase really refers to the whole situation around CEO Elon Musk's pay package. It's still this massive point of contention and shareholder scrutiny.
Yeah, it keeps coming up.
And the outcome of that debate, how shareholders ultimately vote on that compensation package. It's huge, not just for Tesla's stability, but maybe as a precedent for how tech companies handle executive pay across the board.
Definitely one to keep watching. Okay, let's talk streaming. It feels like that market is just in constant motion, always consolidating or changing. Warner Bros., Discovery, WBD, they announced they're expanding their strategic review and are now actually open to a sale.
That's a huge shift, especially for a company juggling, over $40 billion in debt? Their previous plan was to split the company in two streaming and studios in one part, networks in the other. But now, a sale is on the table.
Have they gotten many bites?
The sources say they've received unsolicited interest from multiple parties, including some big names like Netflix and Comcast.
Wow. Okay, so while WBD is thinking about selling itself off, they're also definitely not afraid to charge more. HBO Max just hikes prices.
Yeah, again.
Following Disney Plus, Apple TV, Netflix. Seems like everyone's doing it.
Yeah, prices went up immediately for new subscribers across all the plans. Basic with ads is up $1, premium is up $2 to almost $23 a month now. And the CEO, David Zaslav, his justification is basically, our content is so good, we're way underpriced.
We'll see if subscribers agree.
We will. Now, Netflix also reported earnings. They actually missed on EPS, earnings per share.
Oh, was a content miss? Slow subscriber growth?
No, interestingly, it wasn't about the core business performance. It was due to an expense tied to some ongoing tax dispute they have with authorities in Brazil. Revenue growth, on the other hand, was actually fine, up 17%, right in line with expectations.
Okay, so a bit of a mixed bag, but the core seems okay.
Right. And speaking of Netflix content, they had this really surprising partnership emerge from their biggest hit film ever, K-pop Demon Hunters.
Oh, yeah, I saw that title.
Apparently, it's so popular, it led to this unique licensing deal for toys and merchandise with both Mattel and Hasbro.
Both of them. Usually they compete fiercely for those licenses.
Exactly. But here, they're splitting the spoils. Mattel gets the dolls and action figures, Hasbro gets plush toys, electronics, board games. It's unusual, but shows the power of a massive hit.
Definitely. Okay, let's move to our final section, global policy, profit, and political heat. We saw a surprisingly strong quarter from General Motors. GM beat earnings expectations pretty handily, right?
Oh,
Yeah, beat on both EPS and revenue. Stock jumped over 15% on the news. They also raised their full-year guidance and lowered how much they expect tariffs to impact them. CEO Mary Barra actually gave a specific thank you to President Trump for some recent tariff updates.
Interesting. But beneath the strong numbers, there was kind of a reality check on EVs.
Yes, exactly. Even with GM doing well overall and gaining EV market share, they reported that only about 40% of their electric vehicles were actually profitable on a production basis. So it signals that reaching broad profitability for EVs, it's going to take longer than maybe people expected, even for the big players investing heavily.
Right, the transition isn't simple. Okay,
Yeah.
shifting from corporate profits to tech policy debates, the AI governance clash involving Anthropic.
Yeah, Anthropic, one of the really big AI startups. This dispute is between their CEO, Dario Amodei, and the Trump administration's AI czar, David Sachs.
So what's the core issue?
Well, Sachs accused Anthropic of pursuing a regulatory capture strategy, basically trying to shape regulations in a way that benefits them and locks out competitors. He also called it woke AI. A lot of this stemmed from Anthropic backing a California bill that, among other things, requires large AI developers to make their safety protocols public.
How did Anthropic respond?
Amodei defended the company. He said their mission is just to make sure AI benefits everybody. And he clarified that they actually prefer a uniform federal approach to AI regulation rather than a messy patchwork of different state laws like the California one. So the debate is really about how AI should be regulated state by state or federally, and who gets to influence those rules. Billionaire investor Reid Hoffman also jumped in, defending Anthropic as one of the good guys.
It's definitely a high-stakes debate. Meanwhile, back in the very physical economy,
Right.
we have a battle over beef involving Argentina.
Yeah, and U.S. ranchers. President Trump apparently floated the idea of buying beef from Argentina to help lower high beef prices here in the U.S. This came after the administration had provided some financial aid to Argentina.
Okay, how did that go down with American ranchers?
Not well, at all. U.S. cattle ranchers, industry groups like the National Cattlemen's Beef Association, and politicians, including Nebraska GOP Senator Deb Fischer, urged Trump to reconsider quickly.
What were their main concerns?
They basically said this plan just creates chaos in the market and doesn't solve the real problems. The core issues are that domestic cattle herds are at their lowest levels since 1951, mainly due to persistent drought. Plus, there's this looming threat of a nasty parasite, the New World screwworm, potentially spreading from Mexico. Importing more beef doesn't fix drought or parasites.
So what's the administration's response to the ranchers?
Well, the U.S. Agriculture Secretary, Brooke Rollins, confirmed they are working on something. A pretty big package, she called it, aimed at incentivizing and supporting new ranchers to help rebuild the domestic herd, recognizing that consolidation has hurt the industry too.
Okay, so dealing with the root cause, hopefully. Now let's look at the macro picture.
Yeah.
The Fed, inflation data.
Right. So the Fed cut its benchmark interest rate back in September, and the market generally expects more cuts are coming soon.
But there's some skepticism about the data the Fed is using, right?
Yeah.
Especially the upcoming inflation report.
Yeah, the September CPI report, Consumer Price Index. Investors are a bit wary because the ongoing government shutdown is affecting how the data gets collected. The Bureau of Labor Statistics, the BLS, they actually use some surprisingly analog methods for parts of their data collection. In-person visits, phone calls.
Phone calls?
Why not?
Seriously?
Yeah. So if government workers are furloughed during a shutdown, that data collection gets disrupted, which means the inflation numbers investors rely on to predict Fed moves might be incomplete or just less reliable than usual.
So how are financial advisors telling people to react to this uncertainty?
Generally defensively. The advice seems to be to lock in yields on intermediate-term U.S. Treasury bonds, think 3, 5, 7 years, and also maintain a very defensive position using something called bond ladders, mostly with short-term bonds maturing in 1 to 4 years, yielding maybe 4 or 5%.
Okay, explain bond ladders quickly.
It just means spreading your bond investments across several different maturity dates. So instead of putting all your money in a 5-year bond, you might put some in a 1-year, some in a 2-year, 3-year, etc. It helps manage risk and keeps some cash becoming available regularly, which is useful if you expect rates to keep falling, as many do with the Fed cuts. It's about balancing the risk of wonky data with the expectation of Fed action.
Makes sense. Okay, and finally, just to round out the sheer range of things happening, some political drama, literally involving construction and space.
Yeah, pretty wild. Demolition actually started on parts of the White House East Wing. To make way for a new, privately funded ballroom, it's going to be huge, 90,000 square feet, costing $250 million, apparently requested by President Trump. The White House basically dismissed the public reaction as manufactured outrage.
Okay. And then the space race spat.
Right. Elon Musk publicly criticized the acting NASA administrator Sean Duffy. Musk even called him Sean Dummy on social media.
Oof. Why they ain't calling?
It followed comments from Duffy suggesting that SpaceX is behind schedule on developing its lunar landing system for the upcoming Artemis III moon mission. Because of these perceived delays, Duffy said NASA is now considering reopening the landing system contracts to other bidders, potentially SpaceX's competitors. So Musk clearly wasn't happy about that.
Wow. Okay. What a stack of sources, really. We've gone from 6-minute delivery battles to the $4 trillion potential of tokenized real estate and a domestic beef war tangled up with geopolitics and parasitic worms.
Yeah, and we saw how some of the biggest market surges, like that Beyond Meat jump, can be completely disconnected from the company's actual fundamentals, just driven by short squeezes and pure momentum.
So when you pull it all together, what does it all mean?
I think it means that even as the world races towards these technological extremes, 6-minute delivery, trillion-dollar AI valuations, the underlying physical economy, it's still incredibly important. Logistics infrastructure, commodity prices, even just the government's basic ability to collect data with phone calls. These things are still vulnerable to really old-world, sometimes analog challenges.
There's a real irony there, isn't there? Technology promises instant everything, infinite complexity.
Right. But the success of your next investment, or heck, even just the price of your dinner tonight, might actually hinge on whether a parasitic fly gets stopped at the border.
Or whether the BLS can actually get someone on the phone during a government shutdown to collect inflation data.
Exactly. Which leads us to the final provocative thought for you, the listener. What critical, slow-moving physical system are we maybe overlooking right now while everyone's chasing the next big tech story? Are we paying enough attention to the boring stuff like property deeds or the stability of the food supply chain? Because that's often where the real foundation lies.
Something definitely worth thinking about. Thanks for diving deep with us today.
Always a pleasure.
We'll see you next time.